create a dual purpose for certain assets. In this episode, I'm going to address the question, how to self-insure for long-term care expenses. Get ready. I'm going to share some things with you that maybe you didn't even know existed before as far as your options to self-insure. So my name's Doug Andrew, and I've been a financial strategist, actually helping people prepare for retirement as a specialist now for more than 48 years. And during that time, I've helped a lot of people optimize their financial assets, minimize taxes, and empower what I call their authentic wealth. Well, many times people would come up at my educational events and they would ask me, Doug, what's your take on long-term care insurance? So I'm going to share with you what I usually told these people as far as self-insuring, but now there are two ways that you can self-insure by using asset-based self-insurance to take care of those long-term care expenses rather than maybe paying for long-term care insurance per se. So first of all, let's talk about what long-term care really is and those expenses. Simply put, many times as people age, they end up having expenses that require them to go into a nursing home, a facility for a long-term period. And those expenses can get pretty high as it adds up over 2 or 3 or 4 months. Sometimes it may happen because of an accident when you're younger. But a lot of times, people's nest eggs, their retirement assets, are depleted in short order because of these long-term care expenses. And of course, those who sell long-term care insurance tell you the statistics of how many people will likely have to make a claim and what have you. I know that the reality is you may need to go to a care facility. But many times I do the math and I take the amount of money that people would pay into long-term care insurance policies, which are pretty expensive. It usually requires that you pay premiums the rest of your life into a policy that you will only benefit from if you do go into a long-term care facility. But sometimes those can be pretty expensive, and so you are sort of paying in advance for those expenses by using a long-term care insurance policy, just like any type of insurance. Well, usually what I would tell people is, you know what? I would actually recommend that you consider self-insuring. Now, it used to be there was only the two options. You could buy long-term care insurance and pay a premium, usually the rest of your life, or you could self-insure by having money that's on hand, liquid, and safe that you could dip into that you could use to cover these long-term care expenses. But it would have to be a pretty good chunk of money if you ran up, $300,000, $400,000, $500,000, or heaven forbid, $1 million, which is highly unlikely, but it could happen. But I usually recommended that people do that with what I call a maximum funded indexed universal life insurance contract. I call it the laser fund, and I'll explain that here in just a moment. So many times as a retirement planning specialist, I would recommend one of my favorite vehicles that I personally feel that retirees in particular should have 40 to 60% of their retirement assets be in what I call the tax-free bucket. Because there are 3 big dangers that cause most retirees to outlive their money: taxes, inflation, and market volatility. And unfortunately, a lot of retirees have their money at retirement in yet to be taxed IRAs and 401ks invested in the market. And I go, what are you thinking? See, Wall Street was never built to create predictable cash flow. What you did for retirement planning is something totally different than what you do at retirement for your planning. So many times I would help people reposition their assets. Now, one of my favorite vehicles that allows people, not just retirees, but anybody, to accumulate their money tax-free under Section 72E of the Internal Revenue Code, and then be able to access their money tax-free all throughout their life. I mean, even if they retired in their 30s and 40s, you don't have to wait till you're 59.5, is in a max-funded indexed insurance contract because you can access your money tax-free. Every $1 million can generate $70,000, $80,000, even $100,000 a year. That would be a 10% payout from age 65 if you live to be 120 without depleting principal. Not very many IRAs and 401ks can do that. In fact, most of the broker-dealers will recommend that you only take out 4% a year. That $1 million nest egg, you should only take out about $40,000 a year because most Americans only average about 3.5% with their money in the market in traditional IRAs and 401ks. To me, that's pretty pathetic. In fact, it's unacceptable to me. And so I would oftentimes help people do what I call strategic rollouts, get their money out of those IRAs and 401ks, get the taxes over and done with sooner than later, and then reposition that after-tax money into something that's going to be tax-free the rest of their life. And then when they ultimately pass away, it blossoms and endows their spouse, their kids, their grandkids with way more money than what they shelled out in tax by doing the strategic rollout. Those types of strategies are discussed on this very YouTube channel. And by the way, if what I'm already sharing with you is intriguing you, I would strongly recommend that you click like and share this video with somebody who ought to be watching this. I'm going to share some things with you that you probably didn't know existed. But subscribe to the channel. It's free, and click the little bell so you'll be notified every time I post an in-depth answer to a financial question, which I do almost on a daily basis on this channel. And stay with me to the end because I want to gift you a copy of my most recent 300-page best-selling book called The Laser Fund. So let's go into this self-insurance. Many times, the clients that I would work with would reposition their money, or sometimes I caught them early enough where they began to sock away $500 a month, $10,000 a year, $100,000 a year, and they could sock away money and accumulate it tax-free in what I call the laser fund. And then later on, if they retired at age 50, 60, 70, 80, they didn't have to start taking money out. They're not penalized like you are with an IRA or 401k if you don't start taking out money by age 72. That's why I love the flexibility of the laser fund. In a nutshell, I had many people who would put in like $500,000 over a 5-year period, $100,000 a year for 5 years. They would stop. And that $500,000 would double to $1 million in about 7.5 years on the average. That's a return of about 9.6% average. Yep, tax-free. And so $500,000 would double to $1 million. Another 7.5 years and that $1 million would double to $2 million. Another 7.5 years and that $2 million would double to $4 million. And the last 7.5 years, the $4 million would double to $8 million. Yep. I had many people that started out with $500,000 and 30 years later they had $8 million tax-free that can generate $600,000 to $800,000 a year of tax-free income for as long as they live. So when they would ask me about long-term care insurance or expenses, here's what I would tell them. I would say, well, golly, you are now sort of self-insured because this money is liquid. If you had a long-term care need, expenses, $50,000, $100,000, $200,000, my heavens, you've got $1 million sitting over here. You have $8 million sitting over here for some of our clients. You could just tap into that and it's tax-free. You don't have to pay tax on that, and you can pay for these medical expenses. They are self-insured. They don't need to pay for an insurance policy because they have the money. That was earmarked. So far, so good. So that's self-insuring, and some of these life insurance contracts, if you don't have enough money in there to sustain you, if you had to pull out $200,000 or $300,000, maybe you only have $1 million in there. Some of these contracts have what is called an accelerated death benefit rider, which means if you're insured for, let's say, $2.5 million, you don't have to wait to die to get the $2.5 million death benefit. You can actually get up to maybe half of that death benefit while you're still alive to pay for those long-term care expenses. You're going to be narrowing down the death benefit when you die, but you can actually use some of the death benefit early without having to die to get it to take care of this. Those are some of the solutions that I would tell them. Well, now there's another option. Let me tell you what it is. It's called an asset-based long-term care strategy. So let me frame it this way. There's a lot of people I meet that they have $100,000, $200,000, $500,000 sitting in a bank or credit union, unfortunately earning a pathetic rate of return, usually less than 1%. And I go, what's this earmarked for? Well, it's our rainy day fund. Whoa, that's a pretty hefty rainy day fund. Well, what for? Well, in case we get into a nursing home or we have a physical condition, we need long-term care. I go, okay, so we'll call it your rainy day fund, but you're earning less than 1%. It's just sitting in the bank or credit union. You're rowing upstream at the rate of 1 mile an hour of interest, and the current of inflation is coming out at 3. You're going backwards. What if you were to move that money, $100,000, from this pocket, the left-hand pocket, over here to the right-hand pocket? It still shows up on your balance sheet. It's still an asset. You could still go grab it if you needed it. If you die, you still leave behind $100,000 like you would in a bank. But with the money sitting in the bank, it's your rainy day fund in case of this long-term care need, but there's only $100,000 there. What if you moved it over here into what is called an asset-based long-term care insurance contract with an insurance company? What's the difference? It's still an asset. You can grab your $100,000 if you want it. When you die, you leave behind $100,000. But if you have a long-term care claim, you can actually qualify, usually right off the bat, for maybe $350,000 of expenses when you're in your 60s. If you didn't need to make a claim until you were 80, that might be $650,000 that you could benefit. But it's really the same thing as far as your balance sheet is concerned. You simply move the asset from this pocket over to this pocket. It still shows up on your balance sheet. You still leave behind the money because you can get a refund of your $100,000 anytime you want. But if you have a long-term care need, they will pay it. This is called asset-based long-term care insurance. And so if this is intriguing you, you could even leverage and take money out of an existing asset, maybe even an insurance policy, and put it into this type of a situation, and you're leveraging just in case you have long-term care expenses that become very exorbitant. If this is intriguing you, this is what I want you to do so that you can learn more and be aware of any educational webinars that we do on these type of topics. Here's how you can claim your free copy of my most recent best-selling book called The Laser Fund. So I've been blessed in my life to have authored 12 books thus far, and this one is flying off of our warehouse shelves. We send out 100, 200, 300 of these a week. You can claim your free copy of this 300-page book by going to laserfund.com, L-A-S-E-R fund.com. This will teach you how to diversify and create the foundation for a tax-free retirement. And you'll learn in here why this is liquid in case you may want to use it for long-term care expenses. But also, when you go into claim your free copy, you'll enter our database and you'll be notified when we teach educational webinars that answer questions like this one: how do we self-insure the best way? And so, folks, go to laserfund.com, claim your free copy. You contribute a nominal amount towards the shipping and handling. I cover the rest of that cost, and I fire out a copy to you. And then there's also options there to listen and learn or watch and learn. There's even an 18-hour masterclass on how to optimize your assets and minimize taxes. And there's actually 62 client stories on the other side of this book that teach you how people have implemented these strategies to increase the liquidity, safety, and rate of return on their serious cash. So claim your book, and here's to your brighter future.